right.
Morning sense of things. It's Jeff and Ron here once again for another weekly update of what's going on in the world, both the economic world, the market world, and always a little bit of fun with what's going on in the world out there. Ron, how you doing, bud?
Good morning, Jeff. Doing well. As I always like to say, never a dull moment, and certainly in corporate earnings season and everything else going on, there's always something to talk about. How meaningful it is another story.
That's totally right. I totally agree with you. I still sit and listen to the pundits on the news, and I just every time I listen to them, it's just babble nonstop.
I know we got a lot of good stuff to cover today, so we always got to
Why
start out with some fun.
So you've got the fun part. So why don't you kick us off and tell us a
Yeah.
little bit about what's going on in the world, the crazy world?
Yeah. So last week we had started with kind of on a, I don't know, slippery slope there on worst decisions in business history. So we'll talk about bad products, right?
Mhm.
So this is very important, that packaging is very important. So
Sure.
make sure you grab the right one before you cook anything. I don't know if they just got lazy with their logos and marketing from the same
Wow.
company, or hopefully it's two different factories making this, but just saying.
Just wow. That I've got nothing better to say about it. That's
I
just
don't
a
know. Stick
wow.
around, my friend. So did golfers really buy these? Did they find them even if they didn't hit the fairway on a drive?
That is
We all want to
awesome.
support the military, and I know you were in for a few years, but come on now. Are,
That
are,
is
are we really
awesome.
hitting these golf balls onto green grass?
You know what? I get the ones that are like bright yellow because I know they're going to be in the weeds. So
Yeah, orange, yellow, all good, but I don't know
I
about
don't even know how
camouflage.
you'd find that on the fairway. My God, it's hard enough to find the white one on the fairway.
Come on, it's a ghillie suit for a golf ball.
There you go.
All right. Now, when you follow this fitness routine, you will get buff, grow an afro, and possibly change skin color. So I just want you to
Wow.
look at the before and after.
I am liking this.
Now, if this
This
is
is
what you want to
awesome.
look like, that's fine.
Dude, I want to look like the guy on the right hand side. So if I could do that workout routine and get that buffed up, I'll live with the afro. But dang, man, that's awesome.
I like the sunglasses too, but I'm just saying, who was the one that merged these things together?
That is amazing. I am very impressed.
Now, this is a design flaw to blow up the unicorn, but they could have put the nozzle almost anywhere else.
Oh,
I'm just
like it.
saying,
Wow.
I'm
Okay.
just saying, this wasn't necessarily advertising, but I think you might want to blow this thing up before the kids come and the
That's
parents
I'm thinking
observe.
so. This is a little weird. Yeah. There
Hey,
was
this isn't a Disney
there's
film.
a local like PBS guy that does travel stuff, and he was at a local place, and I think it was down closer to Houston or something like that, and there was a back end of a goat, and they had a bottle opener hooked up to the back end of the goat on the taxidermy. So that's the only way you could open your bottle.
So I'm a conspiracy theorist every now and then.
Mm.
My conspiracy theory is the husband bought this for the wife and knew she was going to blow it up and was ready to get with the camera.
Oh yeah. Oh, I
I'm
can
just
guarantee
saying.
it's a given. Yeah.
Okay, looks like there's something new on the McDonald's menu.
Mice.
So if you got $1 and you're a
It's a
little
buck.
hungry, this may be new to that dollar menu they've been trying to push.
What
I'm
is
not
it? And
sure.
it's a 10-pound bag of mice on top of that for a buck. I'm
I'm telling
impressed.
you, that's a hell of a
That's a
bargain if you're
great
a cat
value. I don't know if they're
or a
sourcing
steak.
them from their stores or where are they getting it for so cheap.
Don't know. All right, almost done. Looks like Spider-Man has to spin his web in a different way, or is he just leading an alternative lifestyle? I'm just saying.
Okay. Spider-Man.
And by the way, lastly, I don't know who's designing these pillows or who's approving them, but I'm just saying maybe you want to look at design first before you put these out on Amazon.
Yeah. Wow. Wow.
Just say it's almost like the Dunkin' Donut thing that we had about 6, 7 months ago, their
Yep.
advertisement.
Yep. Absolutely.
All right, moving on to some serious stuff. So I misquoted. I thought it was Warren Buffett, but it was John Maynard Keynes that
Mm,
I saw was given the credit for the quote, the markets can stay irrational a lot longer than you and I can remain solvent.
mm,
So a couple of things here. This is this morning. I realize it's time sensitive after NVIDIA reported earnings last night. And this move from the October 27th low to now, we've never seen this type of move in history. And all on the backdrop of bad earnings and
mm.
strong employment.
Yeah.
Even though we've seen a lot of retrenchment lately with white collar jobs and high
Mm,
paying jobs, even though that the threat, for lack of a better word, has been called off on rate cuts. Now, the next thing they're expecting is not May as of
yeah.
last week, but now June.
Yeah.
And you and I have been saying second half anyway. So it should be interesting to see how all this impacts, but we all know how this ends. And
Mm.
it's tough to put new work to money at these levels. Not sure what you're telling your clients at this point. It all looks good. The wealth effect is in place, but what are your thoughts?
Yeah, I think I made a big shift last year to add credit positions or credit stuff into the portfolios. I just got tired of playing with the bond markets. We're still riding the stock market, but I will tell you, I am extraordinarily just very cautious right now on the
How
stock
can you?
market. You saw it's just amazing to me what a difference a day makes. Where yesterday and the day before, the world was horrible and the world was ending,
Yeah,
and
right here.
the Fed news came out, and they're not going to change the interest rates in May. And it's like only a 35% chance now. So that's the 35% of morons that still think it's going to go, they're going to lower the rates. And now all of a sudden, oh, Nvidia is great. So boom, the market's right back up again. I think it's going to be very difficult to make money for a bit. I could very easily see this thing going sideways from now until even the election. And you've
Yeah.
got the craziest, goofiest election that has ever existed in our history that's going to be going on. And it hasn't really even fired up. I think pretty much after May 5th, Super Tuesday, you're going to have a pretty clear picture of who's going to be the Republican nominee. We know that who the Democratic nominee is because the Democrats wouldn't allow anybody else to run. It's a given that it's going to be the 280-year-olds fighting it out at this point. And I don't one what there I don't know which one's more disliked at this point. And so I just think you got to either there's going to be a lot of people that phone it in for the election at the end of the year, or it's just going to get crazy. But I think it's going to, I could easily see this thing just going sideways for quite a while.
I mean, I don't know how we can't get at least a 5 to a 10%
Yeah.
pullback, if not 15, as just the normal course of correction. Of course, people will think the Earth is going to be Armageddon in the next week or two if
Mm,
that happens, but a 10 to 15% pullback would be healthy.
yeah.
And then the next thing is we showed this towards the end of last year because we're trying to look for what are possible sectors to look into. And you always look at the bottom four
Yep.
of the prior year to see where they're going to be. And obviously, healthcare had a nice bump, but obviously, these numbers are not going to be sustainable. I think these will get pushed around quite a bit here in the next 3 to 6 months. But the idea is those are probably still the sectors you want to be in
Mm,
throughout the end of this year. It's just really a matter of allocation based on where you are in your timeline.
yeah. It's yeah, I think right now it is the techs to the techs and anything related to AI, both for good and bad. We saw earlier this week there was this anticipation that Nvidia was going to have horrible earnings, which, if you know anything about Nvidia, they're not going to have horrible earnings. They are always wildly underestimating what their next quarter is. They give guidance, but it's usually pretty safe guidance for them, and then they come out and blow it out. But you saw literally everything related to Nvidia and the AI world just get pummeled on Tuesday of this week.
Yeah.
So it was, we didn't have a Monday because of the market holiday, so it just got pummeled on Tuesday morning. And then of course Thursday, the world is wonderful, everything's great, and we're right back to the races at this point because Nvidia's done so well.
Yeah. And it's one stock pulling
Yeah.
everybody behind them or putting them on your back, whatever analogy you want to use.
Because even the Magnificent Seven at this point aren't really pulling their weight. You look at about half of them are just going sideways at this point, and you've got Nvidia and a couple of others that are just off to the races,
Yeah.
and it's likely to be
Google,
that way.
Apple have all pulled back. Tesla's been cut in half, but we'll see. We'll
Yeah.
see here. As we
Well, let
say,
me
never a dull
kind of
moment.
share some of the stuff that I'm seeing out there. So let's take a look at leading economic indicators. This is something that Ron and I follow. This is something that I was taught by a mentor a long time ago to keep a good eye on. And what I would tell you is we have been continually, for most of last year and early on to this year, we've still remained with the year over year change down below, down in the negative. And it actually accelerated this month from where the estimates had been. The estimates were a little bit more muted. It actually came in worse than what the estimates were, but it is starting to crank up a little bit. And when you look at real GDP with the last CPI report and some of the other things have started to pop up. Interestingly enough, one of the senior managers with the conference board who puts it together, I caught this little note as they were explaining out this. The US LEI fell further in January as weekly hours worked in manufacturing continued to decline and the yield spread remained negative. While the declining LEI continues to signal headwinds for the economic activity, for the first time in the past 2 years, 6 out of its 10 components were positive contributors over the past 6 months. As a result, the leading index currently does not signal a recession ahead. While no longer forecasting a recession in 2024, we do expect real GDP to slow down for Q2 and Q3. I look at that as maybe they're hedging their bets a little bit because they've been wrong for almost 18 months now. But we've talked about this with economists before. They are wrong way more than they're right, and it could go the opposite direction.
Look, any market strategist, economist that's worth their salt that I respect and I have followed will all tell you one thing. You can have declining and trending down economic numbers for months, quarters, or possibly years. But unless there's a specific catalyst,
Yep.
right? Typically banking or financial or a geopolitical event. Those are the two major ones that will pull these economic indicators down into a recession level. And we don't need a significant pullback in the market to have a recession, or however you want to say it. We don't need a recession to happen with a significant pullback in the market, because we all know economics is not market, is not the economy. The idea is, and I thought it was interesting on who said this, because the CEO, she's been out there on a lot of the major networks and done some other interviews. She's not the one that came out with this statement.
No.
And we all know that the LEI and other indicators, they may say within this time frame. Their time frames are average.
Yeah.
Could happen earlier, could happen later.
Could happen
It's
way
average.
later.
Yeah. So the fact that in February already they're saying not in 2024, hey, you still got 10 and a half months to go.
There's still a lot of room here.
I think this may be bolder than we may have a recession.
Yeah. Yeah. I honestly think it's way bolder, but we have not had a recession. We really, truly haven't had a recession since 2010, 2030. Yeah. 2012 or something like that. 2020 wasn't, I don't consider 3 months a recession. But the reality of it is we really haven't had anything since 2008 period, that 2008 to 2010 period. So we're due, and it's going to happen at some point. And I don't know what that factor is going to be that's going to finally throw us there. I personally think that the consumer is getting stretched beyond stretched at this point. And
what's the breaking point?
Yeah. Where is that going to break? Where are people going to run out of money? It was
when the banks say you can't borrow anymore because you could barely make the minimum payment.
Yeah.
And now they're going to be crap out of luck for the next 10 to 20 years paying all that off.
Yep. Yeah, and that's the thing is they're going to be stuck in there. You've got people paying or not paying on their student loans because they still think the government's coming to the rescue and just going to wipe out their student loans. I think it's so funny. The one thing that's not been proposed out of this entire thing is just saying, okay, for all the small businesses out there that the government forced small businesses to close and then offered up the idle loans, the economic loans
Payroll, yeah, the
to help
payroll grant.
out. It wasn't even the payroll stuff. It was the economic stuff, which was not forgivable. If they would just come in and say, you know what, we're just going to up to the $150,000 first level of that, we're just going to wipe that out. That if you want to ensure that the world's going to continue from an employment standpoint, that's one thing the government could do quickly, and it's something that wouldn't get challenged by the Supreme Court or anything like that, because it's not adversely affecting anything. All you're doing is helping out the small businesses, but
But
for some
again,
reason
it's
the
free
government
money.
won't do it. We've talked about Nvidia, but the big earnings wins for this week, nothing else mattered besides that's what's affected everything. I think we were somewhat of an unhealthy market last year. It's getting continually more unhealthy. I do monitor a lot of the just earnings reports and things like that. And we had a real swath over the last couple weeks of a lot of positive earnings surprises, as we've discussed before. I think some of this is a lot of these companies pulling back their estimates a little bit so that they can have surprises. I will
Right.
say this week, it's a lot of smaller companies and a lot of surprises to the downside. Most, interestingly enough, are in the energy space. Really a rough time period, especially in natural gas. Anybody that's in that, the government came in and said no new permits for any pipelines or facilities or anything like
Just
that.
manipulation of price.
Yeah. So it's causing some of these companies to, all right, we're up a creek. I heard on the news the other morning there was a company that is building pipeline and stuff like that. And the owner of the company was like, I don't even know what to do at this point because I've got 3,000 people that work for me and I don't know if they're going to continue to be employed at this point. You know, most of them are furloughed. So it's interesting because we hear about these high paying jobs in the, out there. Where are you going to find them? These are high paying jobs for people, and you're basically just killing their jobs off.
Yeah.
Okay, cool. What's your thoughts? I mean, we're coming up to the end of earnings season. Do you see anything else? Any
Well,
major
I found it
players
was
out there?
just two quick observations. I'm not going to bring back up my slide, but when we were going through the sectors,
Mm,
the worst year to date, first worst sector last year, and already worst sector year to date this year's energy.
yeah,
Which I was just talking to another advisor friend of mine who I've known over 30 years, and I'm saying, how, with everything that's going on in the Middle East and the world, how is oil not at least over 90, if not
yeah,
100?
yeah,
And I've been saying for a long time to ad nauseum, oil, precious metals, specifically gold, Bitcoin. These are the three most manipulated markets in the world because of supply and
absolutely.
demand. You can't tangibly understand or touch it.
Mm-mm.
So why do we have a glut all of a sudden of oil? The
Yeah,
Saudis have been pulling back on their production.
yep.
I don't
As have
understand that.
we. You know,
And real quick, and then the other observation was Nvidia. Everybody's been lowering expectations so they could jump over it. Nvidia raised their expectations prior for
yeah,
a blowout quarter, and they surpassed that.
yeah.
That's amazing.
Yeah, no, it's an amazing company. It's well run, and it's one of those companies that if you look at the history of it and say, oh, okay, it's this amazing thing today. But if you look at the history of it all the way back to, I think, 2001, 2002 is when they came into business. I mean, they were literally sitting below $10 a share for
Yeah.
almost 20 years. And
Yeah.
it's just literally been the last 4 or 5, really the last 3 years, mainly because they have wonderful chips for the AI industry. And,
AI, gaming. Yeah, they're in there. I thought it
yeah,
was interesting very quickly as a quick left turn, right turn. There's been some financial media and some people that I follow with their podcast that show a chart mirroring Cisco from the mid to late 90s and NVIDIA as of today, and it's almost in lockstep until 98, 99 right now.
Mm. Yeah.
Very interesting. At one
Yeah.
time, Cisco was the company that had the greatest market cap in the world in
Hmm.
99, 2000, and we all know what happened from there.
Yeah. Yeah. It's amazing. Like I said, they've got some competition coming in. AMD's got AMD, which has always been the also ran. They've actually got some good equipment and
Yeah,
good.
AMD, Intel,
Yep.
a super microchip.
Mhm.
There's Marvell. There's a
Yep.
lot of them out there they'll definitely start taking a chunk out of it. But
Hmm.
right now, 30% of NVIDIA's revenue is from four companies,
Yeah.
and they're four of the top seven stocks in the S&P: Amazon, Microsoft, Google, and whoever the fourth one is, Tesla. Maybe I'm not even sure. I doubt it.
Mhm.
I'd already said Amazon, but it's four of those four companies make up 30% of
Their
NVIDIA's earnings.
revenue.
At some
Yep.
point, how many chips do you need?
Yeah. Well, or you get to a point where you do like an Apple that goes, you know what, we're just going to start creating our own chips and making our own chips. And all of a
Yeah.
sudden, whack, you take a third or more of your or money away at that
I,
point.
my conspiracy theory why those four companies make up 30% of the revenue,
Hmm.
you'll love this one, but it makes some sense. I think it's because they're buying up as much as they can, so some of their smaller competitors can't get the
Can't
inventory.
compete. Yeah. Which is,
They
I
have the
actually,
cash.
yeah, they've got
So
the
I
cash.
may
They can
not need
sit
the
on the stuff
chips,
forever.
but I'll double my order so you can't get it.
Yep. I honestly, that's not a surprise. It wouldn't surprise me if they did that. If they're sitting on tons of cash, why not? Just
Business 101, slow down your competitor by buying inventory.
by buying out the supply of it. Let's switch gears a little
Yeah,
bit. We've started this little education piece of the show. So I wanted to throw my 2 cents in today, and we're going to talk a little bit about a strategy that can improve returns, can reduce risk a little bit overall. And it's a strategy I use with clients, I use personally, and I know you do as well, Ron,
yeah,
is the buying of a covered call. So
100%.
what we'll do is we'll talk a little bit about, let's just say XY stock or XYZ stock at $50. And I'm going to buy 100 shares, so $5,000. And I think the stock's going to go up to $60 by the end of the year. So not a huge move, but it's a decent move during the year. Once again, you do the math on that's up $10 per share on 100 shares. That's $1,000 profit or 20% of my original 5,000. Not a bad return. Actually, pretty nice little easy return to have. I'd bank that one every year. But what if I added covered calls to my strategy? So, what is a covered call? Basically, a covered call is an option. So, you have calls, which are typically a bullish strategy, meaning if I buy a call, I'm buying the right to purchase a stock at a specific price. So, you have what's called the strike price, and you have basically the premium amount that you're going to pay for that strike price. So let's say I didn't want to buy the 100 shares of stock, and I just decided I wanted to buy a one option, which represents 100 shares. I might be able to buy that option depending on how long it is. I might be able to buy that out for a year and only pay $10 or probably less than that, $10. So that would be $1,000 instead of paying 5,000. But if I decided I wanted to own the stock, or if I already owned the stock, I could go out there and sell covered calls. So it's the exact opposite of buying. I'm selling them because I want the premium. And the goal for me is I want that kind of to stay below whatever my strike price is. So
Right.
let's say we're sitting here and we're saying, okay, I own the stock at $50. I'm going to sell a covered call at 55. Maybe the stock's kind of floating around $50 at that point. I want to buy it or I want to sell it at 55. So I'm selling somebody else the right to buy that from me at that price, or me to deliver it to them at that price. So let's take a look at this. So I buy 100 shares, I've got $5,000. And then if I decided to sell weekly covered calls, And I'm a big fan of weeklies because, hey, it's every week, every Friday. They go from Friday to Friday. And the interesting thing is when I started using this strategy, I was using monthly covered calls. So that would mean that I might sell one on the first Friday of the month, and then I would wait 4 weeks, and then that would mature, or it would basically expire worthless, or I had to do something with it at the end of that month. If you look at weeklies, there's one thing is there's four of them, and they typically have higher premiums. So it's a way that I can get four of those premiums versus just one. And it typically would be about double the amount of premium during a month. Okay. So if I were to do this, let's say that stock's just fluttering in that 50 to 55 range. It's really not going anywhere. I figure it'll creep up there throughout the months going forward. Let's say I were to sell those 55 calls every week and I make $30, which people look at that and go, oh, it's only $30. Why would I not, or why would I want that? That can be $1,560. If none of these things worked against me, it's $1,560 over 52 weeks. So now if I had my original $1,000 profit, so let's say it gets to the 60, I have been selling covered calls all the way up. I got my $30 every week. It worked perfectly. I have an extra $1,560. Now, without dividends, without anything else, I have a 51% return for that year.
And this is only on 100 shares.
This is only on 100 shares. If I have more than 100 shares, that just double. That number gets bigger and bigger, but it still works out to be 51% return.
Right, not including any capital appreciation on the stock if it goes up.
Exactly. And I don't even have that. We had that extra 1,000 figuring that it would go to 60. What happens?
This is just the call right income. That's what people need to understand.
Yeah, and it's just income that's consistent week in, week out. So what are the risks? There's three main things that you need to understand. There is a break-even point. That's that point if the stock starts to move above where the strike price is, where that original strike price is for me. If it moves above that, which means they're probably going to take my stock away from me at that point, there's a break-even point, and that is the price where the strike price of the option. So let's say it's a 55 plus whatever premium I receive. In my example, it'd be an extra $3. So now it's 58. That's my break-even point. Beyond that, I'm losing money. Max gain, it's just the premium I received, because the max I can make on this is $30. It's $3 per option, basically. And then my loss point, theoretically, the stock could drop to zero. It's probably unlikely for it to go from $50 to zero in a week, but it could happen, and I could lose my entire investment, plus I'll only get the premium out of it. So I end up with $30 if it went to zero during that time period. Chart wise, this kind of just shows you from a chart standpoint what that looks like. So there's that break-even point here down to about 48. The max gain's only going to be up there at that $30 extra, or the $3 extra point, and then the max loss is pretty much unlimited. It could go to zero. But it's a very simple strategy. It's probably the most basic strategy. It requires a level 1 options at most brokerage firms. And it's a pretty simple and easy strategy for most people to get. They don't really have to understand a lot of the mechanics of options to be able to do this. What's your thoughts, Ron?
No, we just gave a presentation yesterday and explained this to a prospective client, and many of our clients, especially the pre-retirees and the retirees, this is almost the de facto standard for generating income, for stability portion of the portfolio, to not only generate income, but typically on lower volatility positions. And the third thing, hedging.
Yeah.
You think your stock has run up quite a bit. Let's say it's run up to 50 and you're like, my God, this thing's doubled in the last year. You may write a 55 call thinking, hey, the fundamentals are out of whack here. I don't think it's going to go above that ceiling. Why not cap some of your profits, get that additional premium, because even if you get taken out at $55.01, you
Mm,
kept the premium, you kept the dividend, you got an extra $5 in profit.
yep.
Hey, what did we say? Bulls and bears make money, pigs get
Pigs get
slaughtered.
slaughtered. Yep.
So a lot of times it's great for hedging too.
Yeah. And it doesn't mean that you have to hedge an entire position in
No,
that case. You could just hedge a portion of a position.
you got 1,000
Um,
shares, write 5 calls.
Yep. And I've done that before with a client where they had a very large position of company stock. And what we did is we just figured out we were running calls that were over several different strike prices, knowing that, okay, it might take out one. It's probably not going to take out the other 4 or 5 strike prices that we're after. And it was just a nice little continual income stream coming in. And it was a disciplined approach to exiting from those stocks.
Yeah. Yep, no, definitely. And I would say if you're not working with us, you're working with another advisor. If they're not offering this, they're not earning the money that they're charging you in fees.
No.
Period. I can't believe how many people come in with the size of portfolios that they want us to manage, and they've been around for a long time, work with a couple of people, and they're like, did you ever do any call rates? I've heard of them, but no, my advisor, their firm, whatever, they don't
Wouldn't
do
allow
that.
it. Yeah.
I don't get it. I don't understand it. It's just another way to protect and hedge yourself, and why people aren't doing it, I don't know.
I don't know. I think a lot of advisors, quite frankly, don't understand it and they don't want to spend the time to learn at that point.
I agree.
That's the only explanation I have for it, is there's just a lot of advisors that won't put out the effort to do it. And if you're running weeklies, that means you got to do some work every week. You can't go play golf on Fridays. You got to actually do a little bit of work on Fridays.
And oh, by the way, it's tough to get the concept sometimes the first time. So
Yeah.
my last thought to people that are watching this, if you're not doing these, you're not familiar, rewind this and go back. I presented a little bit similar, but a little bit differently, but it's the same concept and it's very simple. There are a lot of very complex option strategies. This is probably one of the more simple ones. And oh, by the way, one of the more safer ones and less risk.
Yeah.
Period.
Yeah. Yeah. Just because it has option doesn't mean it's risky at that point.
Right.
It's a very
Yeah.
simple strategy that,
Yeah, there are a lot of other ways to do options that are risky. This is one of the lowest risks that you have, and you're making money day one as soon as you write that call.
absolutely. Yeah. Yeah. And you know what your risks are and you know what your gains are. It's very predictable and very straightforward. So
Definitely.
hopefully this was something that y'all could learn. I would encourage you, if you're running your own money, take some time to learn this. If not, find an advisor that can help you with this and can help build a portfolio for you with this. Thanks for joining us. We always appreciate this. We'd love your comments. Give us an upvote. If you like this, let us know what you want to hear. Let us know if there's any strategies that you want to hear, because we're going to continue to do that this year. So thanks a lot, and we will see you guys back here the very next time.